Okay.
Hello, everyone, and Happy New Year. Welcome to Idea to IPO. This is 2023. We're here today to talk about what to expect in 2023 in venture capital. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney at K&L Gates LLP, which is a global, fully integrated law firm with 48 offices on 5 different continents and a deep history in tech and venture. I work with venture-backed companies and investors as they deploy capital into those companies. We have a fantastic panel here today. We have Nuno, who is the managing partner and founder of Chamaeleon. We have Ekta Dang, who's the CEO and founder of You First Capital. And we have returning champion, Bill Reichert, who's the general partner of Pegasus Tech Ventures. He's smiling. Both Nuno and Bill have been here before, and it's a pleasure to have Ekta here on the panel today. Before we begin, let me provide you with a little bit of information on how today's panel will run. So for the first hour, we'll have a panel conversation where I'll moderate, try and make sure everybody has equal time, or at least roughly equal time. We will then, after that, take questions for about half an hour. If you've got questions, please use the Q&A function in Zoom. I don't monitor the chat. Perhaps the panelists will monitor the chat, or they may not. It's up to them. But the chat is unmonitored. Additionally, today's event is recorded. So if you are here watching live, fantastic. We're delighted to have you. If you're watching on a recorded, time-shifted basis, fantastic. We're excited to have you too. One comment, of course, is because it's recorded and it will be, put on the internet, please don't share any confidential information. We're not interested in obtaining that today. Now, with that in mind, again, if you are in the audience today, please fill out the poll. It'd be fantastic and helpful to know who's in the room. And at this point, I'm going to allow each of the panelists to introduce themselves, talk a little bit about their fund or their organization, and also provide the best contact information if they're interested in being contacted by anybody in the room today. Maybe we'll start with Nuno.
Well, it's great to be here again. Happy New Year, everyone. I've been in tech now for 26 years. It's going to be 27 in a couple of months. I'm an engineer by background, product manager, was a growth operator in my mid-career. Ended up going to McKinsey after being their client. Interesting story. I was there for 6 years. They couldn't get really rid of me. I've worked in Asia, Europe, now in the US, and then decided to be a full-on masochist and start my own venture capital firm, Strive Capital. Did 2 funds out of that, invested in companies like Robinhood, DraftKings, Gusto, Rubrik, App Annie, Data AI, Verta Health, and a few very well-known companies. And lately I decided that once wasn't enough, so I started the second VC firm. We launched our first fund for that VC firm a year and a half ago. The firm is just called Chamaeleon. We're not Chamaeleon Ventures or Chamaeleon VC, we're just Chamaeleon. A couple of claims to fame. We are based in the Bay Area. We have too many offices actually in the Bay Area at this stage. We have an office in Portugal as well. And a couple of things that are very distinctive about us. We use quantitative methodologies and technology that we build in-house and that we maintain in-house to help us with deal sourcing, due diligence, and portfolio management. To just give you a little bit of a tidbit, we process 20x plus the deals of what a tier 1 fund with a lot of resources would process a year by the deal team. So our numbers are pretty silly. The likelihood that we would reach out to you as a startup versus that you reach out to us is very high. Looking at our funnel for last year, 83% of our top of funnel, which as I said is huge, was outbound, 17% was inbound. And our inbound is larger than most tier 1s process in a year. And the final thing I would highlight about us is we have something called #in within Chamaeleon, which is our network of advisors, portfolio managers, scouts, entrepreneurs in residence, executives residents that we make available to our portfolio companies, as well as our LPs. And last but not the least, I have something called Tech Deciphered, decipheredshow.com, which I run with Bertrand Schmidt, who is the co-founder of App Annie, and the CEO there for the first 8 years of the company, where we don't invite anyone. So that's what's different about our podcast. We just talk. We wanted to invite people at the beginning and we never got around to it. So that's basically it.
Well, fantastic, Nuno. We're delighted to have you back. Ekta, would you tell us a little bit about You First Capital and yourself?
Thank you. Thank you for having me here, and a very happy new year to everybody. So I'm the CEO of You First Capital, which is a venture as a service arm for corporations. And so we have an innovation arm as well as a fund which we use to invest in startup companies. And so far, we've invested in about 20 companies, mostly in enterprise tech. By way of background, both me and my co-founder, Sanjeet, we were at Intel Capital and invested through Intel before. And we've had a long corporate career. By way of education, both of us have a technical PhD. I did my PhD in physics and Sanjeet did his PhD in engineering. And we were in deep technical roles and then gravitated over in our careers over to more venture investing roles. And we wanted to use our knowledge and expertise as a strategic venture arm and bring it over to the outside world, or so to say, democratize the whole model and make venture capital accessible and easier for corporations all across the globe. Now, there are some corporations who are amongst the top 10 or 20 organizations, I want to say, who have nailed it and know it all. But there's this long tail of corporations who really don't have the DNA expertise on even where to begin in their venture capital journey. So we come across as trusted advisors to those long tail of corporations. And we have an investment arm as well, through which we invest in startup companies in enterprise tech, and that's funded by institutional investors, family offices, and a mix of corporate execs as well.
Well, terrific. We are very excited to have you on the panel today, Ekta. We had your co-founder in the past, and it was wonderful. So looking forward to it. And Bill, tell us a little bit about Pegasus Tech Ventures in your career.
Sure. Yes. Well, first of all, again, thanks for inviting me back, and I am always delighted to be on the panel with Nuno and Ekta. Great to see you guys again. Happy New Year. Looking forward to this discussion. In terms of Pegasus Tech Ventures, Pegasus is a global venture capital firm with our headquarters here in Silicon Valley and offices around the world. We have a little over $2 billion of assets under management. And we manage those assets, very differently than a traditional Sandhill Road fund. We actually have over 30 separate funds that we manage, which are generally single LP funds that are funded by multinational corporations. So similar in vein to what Ekta and Sanjeet are doing, working with corporations, we actually are GPs for strategic funds for corporate investors and some financial funds for family offices around the world. And so with over 30 funds, we cover pretty much everything that you could imagine covering at pretty much every geography, pretty much every stage, pretty much every technology. So yes, to one of the comments in the chat, we do space tech. We're investors in SpaceX, we're investors in Space Ride, we're investors in a few other space tech companies. We do nanotech. We've invested in a few nanotech material science companies. We do medical devices. We've invested in a number of companies in the health tech space, both devices and molecules. And then all the other categories you can imagine, AI, enterprise, smart factories, smart houses, smart cars, smart buildings, smart cities. We invest across the board. So we have over 250 companies that we've invested in over the 10 years of Pegasus. So we're looking for entrepreneurs, that fit somewhere in our profile where we can bring 1, 2, or 3 of our corporate partners to the table to help accelerate the startup's success. And conversely, we're looking for startups that fit into the innovation strategy of our corporate partners or the investment strategy of our family offices. So by background, I started out here in Silicon Valley a long time ago. Nuno knows to the month how long he's been involved. I've long since lost track of how long I've been involved, but long ago and far away, I started my first company while I was a grad student at Stanford. This was actually before it was fashionable for grad students at Stanford to start companies. So I was a serial entrepreneur, wound up, 2 of my companies went public. And then I started a venture firm with Guy Kawasaki. We started Garage Technology Ventures. And then a few years ago, we merged Garage with Pegasus. And so now I'm a general partner at Pegasus. So that's my particular background.
Fantastic as well. We're delighted to have you back, Bill. And let me tell you who's in the audience today. So we've got a strong contingent from the Bay Area, about 50%, which really surprises me, given that this is the first day we haven't had rain in probably 3 weeks. And then sort of 30% from elsewhere in the US, and then sort of a handful from elsewhere, South America, Europe, and Asia. A lot of folks actually tune in and watch the recording. So again, if you're not announcing those numbers, we appreciate you and thank you for attending on a time shifted basis. So 2023, wow, we did this panel last year. And I thought maybe what we could do is and actually we even did it halfway through 2022. But I thought maybe what we could do is we could kind of go back in time just a little bit, talk about the market conditions in 2022 and how maybe they shifted throughout 2022 and shifted and are perhaps going to shift in 2023. And sort of with that, with the data that's sort of come out, and I've just taken a quick look, I mean, it looks like 2022 was not a bad year. It was comparable to 2021, but, the devil is in the details on these things, where first half, started to fall a little bit in the first half, but then the second half of the year, there was nearly sort of quite a drop, if you will. Bill, rest of the panel, you want to weigh in and share with us a little bit about what you're seeing in the market?
Well, first of all, I'm wondering if you, I think you did record us. I don't know if you're going to hold us accountable to what we said last year. Don't
worry, Bill. No, and you know what? My recollection of your responses were that you tempered them. And so I think you're safe.
I'm sure we were. Yeah, I'm sure, Nuno and I were 100% accurate, right? So,
we always are.
Unless you drag out the recordings, then, we'll stick with that. But, it's, I just want to warn everybody that the statistics that are collected on the venture industry are grossly misleading in terms of whether you're going up or whether you're going down. And so, yes, what we're seeing out there is, what we're feeling on the street, at least we are, and Ekta, you can chime in on this, is yes, there is a significant change in mindset. And so there is definitely an awareness that we need to be better about pricing deals. We need to be better about burning cash. We need to be better about our financial projections. So there's definitely a shift in mindset, both on the entrepreneur side and on the investor side. But there is still a ton of money out there interested in investing in innovation. And so a big reason that the statistics show a collapse in Q4 is because the irrationally exuberant late stage unicorn $500 million stuff that curbed, and so that's where most of the money was going. Most of the money was not going to early stage companies, obviously. And then the flip side is that a lot of companies simply said, oops, we're going to delay our next fundraise. So, the number of deals drops because everybody says, oh, crap, it's going to take longer. We got to be more careful. We got to get to a higher milestone. So, semi-voluntarily, that number is going to go down. And then, realistically, in terms of the market, yes, it's always been hard for early stage companies to raise money. It has always taken time. It's a little bit harder now. It takes a little bit longer, so that affects the statistics. But in terms of what's really going on out there, I think these statistics are misleading. And it doesn't matter that much if you're an entrepreneur. What the statistics say, what matters is your ability, to hit your milestones and to justify a follow-on round. But bottom line, what has review of 2022, we did almost 40 deals during the year. So we're a very, very prolific investor. so that's the nature of the business that we're in. But in all of those deals, we were co-investing with other venture guys, and there's no question there's still plenty of appetite out there, for unique, innovative companies with a compelling value proposition. So with that, let me toss it to the gang.
Yeah, I would say, I think at a macro level, one, we sort of got it right. I'm pretty sure I remember this correctly, but Bill and I were both saying there was a bubble and that it was a game of chairs, and at some point someone was going to have a problem. It's very funny because Bertrand and I were looking, we did a 2-episode thing on the bubble, and we launched the second episode literally the week, this is coincidental, but literally the week of peak bubble, which was November 2021. That week we launched the second episode on the bubble. So that was clear, it was coming. I think the effects of it are pretty clear now as well. With COVID, we've had a ridiculous amount of inflation. People are now struggling to figure out what assets go into what pockets at this stage, because they're no longer getting, for example, the alpha that they should get in public equity. The alpha was there for a long time and then it wasn't. We've seen a lot of amazing venture capital firms that we all probably respect around the table making the absolute wrong calls on when to liquidate their public investments. Again, showing that the industry is probably not as good at portfolio management and liquidation as we all like to believe that it is. If you think that our job is to choose great deals, get into them, and then liquidate them, seems like this is sort of the second most important thing, if not maybe the most important thing. And as an industry, again, there's a lot of now data that shows that we're maybe not as good as we should be. I think the second thing I would say, with inflation being there, obviously interest rates have gone up. There's concerns about recession. I'm talking about, what's going to happen in 2023 a little bit already, but I strongly believe that we're going to have a recession, that the worst hasn't happened yet, that the early nuclear winter of crypto with Luna and Terra and then FTX and all that stuff is just at the beginning as well. I am very bullish on crypto and blockchain in the long term, but very bearish right now. And I've been for a couple of years because the noise to signal ratio was pretty silly. We as a firm, maybe just putting in our parochial interest in there from the beginning, because it was actually part of our intrinsic thesis that there was a bubble going on. We were very disciplined around valuations very early on, even when other investors weren't. We can't say that we got into many party rounds. We got into very, very good valuations. At our last session, I'm pretty sure I mentioned this, we were already talking to our portfolio companies about 24 to 30 month runways instead of 18 months. So runways, for those who are not aware, is how much cash do you have in the bank? Sorry, how many months do you have with cash in the bank that you can survive with your current burn rate? So you'll run out of cash after 18 months is what runway means, or after 24 or 30 months. We'd already pushed our portfolio companies to think about 24, 30. Honestly, the only issue we've had in our portfolio for this particular fund is one company that was running out of cash because they were doing too well. And they were having difficulties, for example, in getting debt and line of credit at that point in time. So that's the only company there where we had to have this discussion on, okay, they're doing so well that they need more cash. Maybe we should actually give them that money. And we did as a firm. I don't know, it's been a really interesting year. It was our most active year. As I said, we've been around for a year and a half, but we really ramped up our investing last year. We think there's a lot of great opportunities. The last point I would leave with people in this call is we've gone through maybe 4 or 5 years where little by little, and then there was a peak, the value, the sort of the people that would set the conditions, the power, let's call it power. The power went to entrepreneurs. The power around negotiation of deals, the power around the clauses that they put in term sheets, the clauses that went into agreements. It migrated dramatically towards entrepreneurs. There was a lot of party rounds where everyone accepted whatever valuation was out there. Those times are done, right? It's gone back to investors, and it's going to go even more. And that cycle happens in venture capital all the time. Obviously, Bill will know more than I do because he's been in this space for longer than I have, but I've seen enough cycles to know that it's always like this. And it's good because it provides balance, right? And so maybe some guys who 2 years ago were raising on some ridiculous valuation now are having difficulties, are going to be subject to a down round or a flat round. And if you mistreated, your VC, the VC that you were talking to 2 years ago, and you just told them to go and do whatever, and now you want to raise from them, good luck, right? Because you might raise from them, but there will be many strings attached right now. So again, I think that shift in power is good. It's good that we get these cycles once in a while. It goes to entrepreneurs sometimes, then it goes to investors and all of that.
So I want to allow Ekta to follow up, but before I do, actually, Nuno, you used the term party round a couple of times, and you did a great job of sort of unpacking a couple of other terms that you use. Could you just unpack that real quick and what the import is? And then I want to make sure that Ekta has a chance. Yeah.
Party round is where a variety of investors come together to do a round. It's normally unclear who the lead is or co-lead, and everyone's coming in normally at a valuation that doesn't make much sense to anyone that would sort of think through comps, etc. So a party round is, effectively it means the entrepreneur is throwing a party, invite a bunch of people, they're all coming in and giving you money, right? That's basically it. That's what a party round means.
These are company led.
Yes, it is company skewed, and it's company skewed, but it's actually not necessarily good for the company. I think that's the thing.
And we'll definitely circle back to that, and we'll talk about valuations
for now on the definition.
Yeah. Please, Ekta.
Yeah, I come from an analytical background. So before I start with an opinion, I want to throw out the statistics that we are all talking about here. And especially I got them off the cuff from a report. So the venture funding dollars that went into 2022, if you look at it exactly in the US, was 198.4 billion actually, and it was down 37% in 2021. It was up 31% when compared to 2022. So that's one to keep in mind. Then, the unicorn birth, as we were talking about, also showed a sharp drop on an annual basis. And between 2021 and 2022, the new unicorn count fell by 52%. So with that said, I totally agree with Bill that does not mean the sky's falling, really. And there has to be some understanding that we need to provide in addition to the statistics. I totally agree with Nuno that party time is over. So there has to be some correction with regard to valuations that were justified, or I want to say not so justified, and still went by or flew by. There was with COVID came a mad rush for digitization, and there came a mad rush for tools that provide online communications, online learning, and digital health. And there was a sharp decline in investments around technologies, particularly in on-site retail. So all those trends that came in heavy with the start of the pandemic, and as kind of the pandemic peaked up, will now see some market realization, and the entrepreneurs who were driving these sectors will now actually see what truly is resonating with the market, not the market that was scared by the pandemic, but the market that is kind of into a reality check and is kind of normalizing towards what are the business models that are for a long shot and for a longer term. And so, we are looking at companies actually that are providing some insights into, hey, you've taken an enterprise decision to go for a mad rush towards the cloud, but now I'm going to show you what sort of optimizations are possible. What are you actually paying? What sort of shadow IT exists in your organization, and how to have a better control over all the spending that you did madly when the pandemic hit you. So those are some of the examples of companies and also sectors and subsectors which will see some sort of a market shift because they are now entering into a different external reality than they were in the midst of the pandemic.
Ekta, you brought up a wonderful point, especially as we talk about the data there in terms of the what's happened to the unicorns, sort of late stage, if you will, and sort of access to capital versus kind of the early and seed stage has been pretty strong up into the third and fourth quarter. Can we maybe unpack a little bit about the mechanics or the reasons for why sort of late stage growth stage has been maybe disproportionately affected in 2022 and what that means kind of moving forward? Do you have any thoughts on that?
Yeah, absolutely. So like I said, the sectors that benefited out of the greed, the sort of not of the greed, but the fear of the consumers will particularly see a reality check. And they saw in the later half of 2022, and they'll see more of it coming into 2023. So for example, companies who were having they sort of created a simple communication platform without much IP beyond it, and were trying to build a reasonable marketplace for digital health solutions, they are going to see a serious reality check because the underlying IP is not that strong to justify the kind of valuations they were getting. They are definitely going to see a wake up in terms of their revenue and their market acceptance, because at the end of it, in today's world, there isn't much. There are a lot of communication tools, and there's not much value essentially that they have built by establishing a communication between the healthcare provider and a patient at home, for example. And cloud-related companies who sprung up in 2022, and there's a whole lot of companies around providing cost optimization solutions, providing education and essentially shifting left the consumption and better understanding and analytics of how the cloud needs to be consumed, and how the developers should essentially write code in a way that they are conscious about how much of the infrastructure resources they're going to tap upon. All those reality checks and understanding are going to be much more important as we go into 2023. And those companies who are saying, hey, what you did as a response to the pandemic, the way you kind of indulged into digitization solutions and cloud, well, there needs to be some sanity, there needs to be some structure, and it needs to start first with an understanding of how you consume your infrastructure, how different teams in your organization are consuming that infrastructure, and how to kind of optimize those solutions for the health of the company as such. And particularly as cash gets constrained from smaller all the way to larger companies, there will be more of a CFO driven innovation that will be accepted by these companies than the CTO, particularly, who was like, hey, I just need a digitization solution. I need to have a handle of what I'm doing, and I need to do it in the cloud, and I need my developers. I know they're scattered around the globe. I can't meet them. So all those panic reactions that came as a result of the pandemic are going to see a reality.
Bill, it looks like, or did you have
I wanted to, in terms of wrapping up on this sort of transition, 22, 23, talk about another dynamic that I think is pretty important, that is a separate dynamic here, which has to do with what's going on in the venture community, as distinct from the real world that Ekta is talking about, which is to say, in the venture community, there's this oddity that a lot of entrepreneurs don't appreciate about the stresses on venture capitalists around their LPs and fundraising, which is affected significantly by the public market. And so what has happened in the venture world is the public market, even though Dow hasn't made that much of a dip, the tech companies have made a tremendous dip. And so the comparables that everybody's looking at in terms of valuing companies are shifting dramatically. And the way the institutional investors are working, I had a kind of long conversation with an institutional investor friend of mine who said, Bill, you know, the institutions are upside down in their allocations because the pension funds, the endowments, they have allocations to private and to public. And when the public number crashes, that increases the percentage of private, right? The private markets are slower to reprice than the public markets, which reprice daily. And so what the institutional LPs are telling the venture capital community is don't come back to us for more funds. And so the institutional investors are saying to all of their GPs, don't come back to us for more funds. We're not even going to consider new GPs, and we really don't want to have to put more money into you until this thing gets sorted out. And so the institutional VCs, the VCs that depend on institutional money, they are, because of this weird sort of market effect, they're having to slow down their investments. The smaller, newer funds are going to be challenged to raise their next fund because, you know, the timing, depending on the timing of their initial investments and the time they need to raise more money, it ain't going to look good. And even the bigger funds are being told by their institutionals, hey, you know, if you can hold off before you come back, please hold off. So there's that drag as well that is kind of inside venture capital baseball that is going to affect the numbers going into 2023.
I have a slightly different perspective than Bill. So I agree with what he said regarding fundraising right now for VC firms is going to be very, very difficult, you know, increasingly difficult going forward.
Right.
I agree with the comments that he made around the public equities dynamic. So the part where there's a slight nuance here is there have been funds that have raised a ridiculous amount of capital commitments over the last 2 years, right? Like 3, 4, 5x from where they were.
Yeah.
Right. I mean, in the aggregate, just to put the data in there, in the aggregate, it was 154 billion in 2021 and 162 billion in 2022.
This is capital commitments. Now, it's very important here to clarify to everyone on this call that doesn't understand venture capital, right? When we say it's $100 million fund, it doesn't mean we get 100 million in the bank. We do, the 100 million is committed to the fund. We do capital calls. We call the capital when we need it for our management fees or for investment. So it's not the same as a startup gets a check for 100 million. We get commitments. So the part where you need to be nuanced is, one, you might say that Bill is sort of right because funds will have potentially some defaults from existing LPs that won't put all the money that they have in, or they need to make that money work longer. But normally you're committed on the fund on what your investment period is. And when you're doing follow-ons, maybe you allocate more for follow-ons and you allocate less. So there's a little bit of rejigging there. But actually the good news is there's a bunch of large funds out there that do need to deploy their capital within the next 3 to 4 years. Now they might hold on right now, but at some point they'll need to deploy the capital because they have investment periods. An investment period for a fund is the period of time under which the fund makes new investments. So many of you have heard that most funds are 10 years plus some extension time. The investment period is not 10 years. The investment period classically used to be 5 years. It could be 3 years, 4 years, depending on the fund. So that's the time you have to make new investments. Then the rest of the duration of the fund is to manage your existing portfolio or make follow-on investments in existing investments. So very important to clarify. I think the good news for some entrepreneurs is maybe there's going to be a little bit of a buffer right now where people are being very cautious about investing. They're being very thoughtful about investing, but at some point they'll need to deploy that. That's what we call dry powder. There's a lot of dry powder in the market right now, and that will have to be deployed. So raising new funds will be difficult, but the funds I've already raised and the commitments I already have, I'll need to deploy them at some point.
Yeah, okay, Nuno, sorry to do this, but again, you haven't been through 2 crashes. And so what happens?
It's not true. It's not true,
Okay,
Bill.
whatever.
I have been through
So
2
here's the
crashes. As I
point.
said, I've worked for 26 years plus,
Right.
right? So
So
I've
the
been through
point
2
is
crashes,
that the last time around, and what is happening now is the institutional guys are saying, hey, I know your investment period is ending whatever. That's okay. We'll give you an extension. You don't have to deploy the money by that date. So the institutionals are pretty smart about this. They're not gonna tell VCs you have to deploy our money.
We disagree on this. I've talked to a bunch of really large funds that have leveraged, gotten up 1.5 billion in commitments and stuff. It's not the case for everyone. It depends.
It depends on where the money comes from. That's fair. It depends on where the money comes from. The other thing that is important to understand is that the diversity of funding for venture capital has expanded dramatically over the last 10 years. And this is something that, I've learned, with the transition to Pegasus, is very interesting that, to me, it used to be that the corporates were kind of the first ones out when things got tough. And what is interesting to me is that it appears that this cycle, it's the institutions that are hanging up before the corporates, because the corporates, at least our experience is, the corporates, they've got this sort of 2030 deadline to transform their companies and to innovate. And so they've got a limited amount of time to build their next billion-dollar line of business. They are not slowing down. The corporates have a longer term perspective. The institutionals, which we used to think were the longer term perspective guys, it's the institutionals that are being a little bit more volatile in terms of their commitments into the category. And so we're certainly going to see that at the top end of the late stage, sources of capital. Not sure where the good solid guys like, the Harvard endowments and guys like that, I think they're going to be more solid. And I think, to your point, Nuno, the big guys who have commitments from Harvard and Stanford, those guys are much more solid than some of the newer players that have come in at the edge. But okay, so that was a little bit nuanced. Okay.
I totally agree with you, Bill, here that the corporates are not slowing down. And that is not a surprise to us, at least, because they have been coming into investing with a strategic interest in mind. And with the market turbulences, that strategic interest is not going away. And we as YouFirst Capital, we feel we have flipped the venture model somewhat by doing a lot of diligence and a lot of work into understanding and strategizing and discussing what sort of innovation is helpful for the corporations. And with that sort of an understanding that comes out of peeling like 10 layers of the onion before the corporations even put their cash down, is have at that time when the corporations are putting their money down, they've already panned out the ROI. The business units are already engaged with the company. They know what to do with the technology. And despite the market turbulations, where they were thinking in terms of jointly collaborating either on the technology side or the go-to-market side or the business model side, that aspect is not going anywhere.
Mm-hmm.
Could we spend maybe no more than 5 minutes just maybe breaking up at least what I've seen and what the data seems to indicate, especially when we're talking about non-traditional investors, which would include corporate VC and would include crossover funds. There was a tremendous turbocharge in the market in the last few years, especially kind of at the later stage. Certainly in the earlier stage, we're seeing they are continuing to play. In the earlier stages, they are playing, and they are playing heavily. But they do seem to have pulled back a bit in the later stage deals, just as later stage deals in general, I think, have fallen. Are there any comments on that? Or I'd love to shift to sort of strategic things that entrepreneurs.
This was generally a bubble, right? I mean, this is the definition of a bubble. And it actually started in public equity markets. It did not start in private markets. It started in public equity markets. And it rippled back. So
Right.
late stage deals were just a natural thing. It's like, why? And you looked, there's metrics that people follow, right, in this industry. There's a metric, called TVPI, total value to paid in, right, which is your total value of your assets on your books versus what the money was that you paid in. And the total value includes stuff that is imaginary. That's a valuation that someone came up with, right? It's not cash, right? That's not distributions to pay them, cash on cash. It's actually just what you have on the books. And there were private equity firms and growth funds that were investing mid-stage and late stage that were like having incredible numbers on their books, right? They look like, it was like almost stupid to be a venture capitalist, because it was like, we come in with so much risk and we seem to have lower returns than these guys, right? I was looking at guys like, why should I invest in your firm? If I'm looking at this PE fund, I won't say the name, but it was considered a tier one private equity firm. And I'm looking at this fund to invest in, and they're showing me these numbers. Well, those numbers, to my friend who asked me that when he was thinking about investing in us, were imaginary, right? They were on the books. They weren't liquidated, right? And then what happened? Now life happened, right? The funds don't look great anymore. Again, it was a bubble. It's the definition of a bubble. It happened throughout. There were forces with a lot of capital to deploy, also late stage, that made this happen. We've had movements, very significant movements from late stage public equity market investors, hedge funds that have significantly and over time come to growth markets and investing as growth investors, and even into venture. Some of them have done well, and we have great firms out there that have done well. Most of them have not, because private market investing, in particular early stage and mid stage, is very different from public equity markets. And that's what happened. What happened was optional value. I mean, we saw this with a player that shall go unnamed. You can Google them. I'm sure it's clear, right? Hedge fund, private equity funds, the guys, right? They come into venture and they start deploying capital at the velocity of light, right? No DD, okay? And then they start putting money to fund managers, into basically VC firms as well at the same time. And then they started reneging on it. They threw term sheets to startups where they said, no, we're no longer interested, or we need to renegotiate the valuation. They did capital commitments to some people where last minute they didn't really come in, or they came in and they said, we have to renegotiate, we're going to put less money in. You can Google it, you know who it is, right? These guys are very good. They're very good investors. They decided they had figured out how to do VC and venture capital. And some guys did the same thing for growth investing. It's the same thing. It's the new players that Bill was mentioning earlier, right? There's new players everywhere. So, it is what it is. There was too much capital.
So I do not mean to sort of cut the panel short on this, but I do think the panel wants to weigh in on maybe some, so looking at the audience poll, there are a good number of first-time entrepreneurs and a good number of folks who are in early stage companies, and then also some that are in growth and late stage companies. It'd be great, given that each of you has gone through a number of, gone through the business cycle a few times, if you've got any thoughts as to how to weather what strategies and tactics to take if you're an operator, whether it's raising capital or preserving your capital if you've just raised. Love to get your thoughts.
Yeah. Well, and that brings one of the comments that's in the chat room to the table, which is the role of the angel community in the whole venture ecosystem. And so one of the, if I'm advising an entrepreneur these days who is what we now call pre-seed, Jesus, okay, but who's who's starting up their startup, it's really important, really valuable to get really well-connected angels around the table, because unless you're a serial entrepreneur and you've already made a ton of money for a bunch of VCs, it's really hard to get any of our attention. The numbers are just so overwhelming in terms of the number of entrepreneurs that are looking for money compared to the number of deals that practically we can, pay attention to. So, God bless Nuno is trying to automate that to some extent. But, venture capital community is just, it's very inefficient in terms of deal processing. So it's just really hard to get the attention of a VC. And in my experience, the best way to get the attention of a VC is to have an angel investor who is well connected, who can vouch for you and help you with the connection. And so I would, if you're early stage, even if you've already think you have enough money and you think you're ready for venture capital, if I were you, I would go try to find the best connected angels to participate with you, and be part of your company. Unless you already have an extraordinary pathway to connect with VCs, probably an angel is going to be your best bet. Alternative to that is there are a few accelerators that are good at this. So if you're early stage, the best accelerators, Y Combinator is kind of crazy in terms of the likelihood you're going to get in. But, guys like Alchemist, guys like Techstars, there are a few other accelerators that are pretty good at doing this and helping you out. So again, the VC community is looking for signals that differentiate you from, this incredible sea of startups that we're looking at. And so anything you can do to differentiate yourself by having a proof point of someone who is invested in you that we consider to be credible, even if you don't need their money now and you think you're ready for the next round, I would try to get some of those, sources on board.
I will maybe would segue just because I agree with everything that Bill said, which doesn't happen all the time, as we all know. Everything, right? If you're raising right now, or if you're starting and whatever, friends and family, angels, but important to get people that get recognized later on. Accelerators might be a great way to get there. Think through making the money work longer, as I said, 24 to 30 months. This also applies to very early. So I'm not going to add on that. I'm going to add on the other case of you have an existing company, you're okay, maybe you don't need to raise immediately. What should I do, right? The first thing is control your destiny. And you control your destiny through two levers. It's very simple. Costs. Can I cut costs that don't dramatically change my position in the market, etc.? Or revenues. Can I charge more? Can I get more clients right now? Can I get prepayments on my contracts? Can I ask my clients to pay in advance? A lot of people forget the second one. They forget the top line, right? But you can actually shift your top line with pricing changes, et cetera, right? So that's one lever that you definitely do. The second lever that you have is your existing investors. Go and talk to them. Have a real serious conversations like, I'm running out of cash in 4 months, 6 months. I should be fundraising right now, right? By the way, fundraising takes at least 3 to 6 months in a good environment, let alone an environment like the one that we are in today. Have that conversation with them. Are you willing to bridge me? Are you willing to put a stake on the ground saying, okay, you can go raise, but I'll give you some money as well, so that when you're fundraising, you can say that we're in. Have that discussion relatively early on. If you're doing really, really well, you're going through the roof and magically you're actually creating profits, continue doing that, right? Maybe use some of that to actually generate the ability to go to the market, hire amazing people. There's a lot of layoffs all around. There's a lot of people that want to try and go into startups for the first time. There's a lot of small companies that are getting butchered and killed, where you can do simple hacker hires or bring that company or that talent on board. There's a lot of opportunities in the market right now that are fundamentally there, to the point that Ekta and Bill have made earlier. Digitization is here to stay. That COVID gave us that. We have done that digital transformation in an accelerated manner, right? Corporations need to actually change now because our bar as consumers has changed. And then the final piece is always have that plan B. Always have that cockroach plan ready to go, right? It's like, what can I do to just barely make it, right? Survival mode in case I can't raise, in case my internal guys are not going to give me more capital, in case magically I can't do stuff with my P&L that will shift everything else, right? The cockroach plan is something that's very, very important. How do I stay alive to fight another day in case everything else fails? You'd be shocked on how few entrepreneurs actually have this, right? Because, an entrepreneur normally is an optimist, right? In principle, should be relatively optimist, right? Or have delusions, right? One of the two things. But honestly, having that plan is very, very important. What would we do if push comes to shove?
I do want to add here to Nuno and Bill, In this environment, I think entrepreneurs really should count on getting a pool of advisors to really to understand and to make sure repeatedly go over your pitch with them and understand whether what you are offering to the market, is it really a painkiller or is it a vitamin? And if there are advisors who are leaning towards, hey, this is more of a vitamin than a painkiller, then you need to really understand how to kind of up level your product and then assess on how you are going to go to market with that particular product. Now, if not everybody is creating a breakthrough product. And let's say if you're a data analytics company, there are a ton of solutions out there. What you really need to do to differentiate yourself is who your partners are going to be. Are you making a particular existing tool that is very pervasive in an organization perform better, bring some efficiency to it, reduce cost in terms of operating that tool? What is your value proposition? You need to be really crystal clear. And you need to have those pool of advisors and partners to help you understand whether you have really been able to establish your product market fit and what your market really is. Don't come up with a lofty addressable market, because when you're bringing a solution that an investor is very aware of, then you really need to go into the lanes and the niche market that you are serving, instead of spending time and sharing a lofty vision that the investors as well as the market is not going to buy.
So Jason, can I take that opportunity to advertise my book? Is that okay?
Well, I was going to suggest that. I was also going to throw you another softball, which was you mentioned accelerators that are helpful to sort of raise your profile and make connections, but are there any competitions that are out there?
Oh, wow. Thank you, Jason. Yes. So for all of you global entrepreneurs, one of the programs that I'm proud to be part of that is sponsored by Pegasus is what's called Startup World Cup. Startup World Cup is one of the biggest and richest startup competitions on the planet. And so depending on what region you're in, there hopefully is a regional competition wherever you are, and then we obviously have a big Silicon Valley regional competition every year as well. But Startup World Cup runs competitions in regions around the United States and around the world, and then we bring all the winners to San Francisco, and they compete for a $1 million grand prize. So go to startupworldcup.io and find out if there's a competition near you. And then meanwhile, before you go on stage to pitch, what you need to do is buy my book, which is called Getting to Wow: Silicon Valley Pitch Secrets for Entrepreneurs. And that is it's the written version of a workshop that I've done for many years to try to help entrepreneurs do the things that Ekta was just saying. Don't pitch a delusional market size. Make sure that you have a compelling value proposition. Provide us with some evidence that what you're saying is true. But overall, you just have to make sure that you are getting your point across clearly. And the challenge that most entrepreneurs have is they're so deep into the weeds with their companies that they just don't know how to be clear, to be compelling, and to be credible when explaining their company to potential investors or customers or whatever else. So Getting to Wow: Silicon Valley Pitch Secrets for Entrepreneurs at an Amazon.com near you. Thank you, Jason.
Thank you. And if an entrepreneur who's listening would like to reach out to Pegasus or to you, is there a good contact information, or what's the best way to do that?
Yeah, I'm Bill at PegasusVentures.com.
Got it. Ekta, would you tell us a little bit about some of the initiatives at You First, and also your contact information if you want to be contacted, or what's the best way to reach out to You First if you're an entrepreneur?
Absolutely. So I'll type in my email address in the chat. Actually, it's ekta@youfirstcapital.com. And with You First Capital, we've been very actively involved in doing events. Now, prior to COVID, these were all in-person events. And we've hosted some very good thought leaders on sectors like fintech, health tech, and other areas as well. And we continue to do that, but it's more online now. We are hosting the managing director of City Ventures next week, actually. Matt Carbonera, and it's free for startups. So please register and get your pitches ready to invest pitch to these investors, actually. And then with You First Capital, we've been very connected with academia as well. I've taken some positions in the past in academia because didn't want to lose sight of all the energy and enthusiasm and new breakthrough stuff that's coming in from that world. So I've been an EIR to UC San Diego chancellor, actually, and have been very involved in entrepreneurial communities across some of the schools in Bay Area, Stanford, Berkeley, Skydeck, etc. So definitely those are good channels. And with You First Capital, we do want to tap into these advisors as well as ecosystem partners, so to say. We have across these schools. So if a corporation or an investor comes to us looking for a particular technology, we have sort of an unfair advantage in getting back to them very quickly and say, hey, these are our partner schools and we've scouted them. The answer could be a yay or nay, but it's the quickness at which we can respond back to our customers, I think, is of help, particularly to corporations who are looking for some technologies that are not out there in the prime market as yet.
Wonderful. And Nuno, tell us a little bit about yourself, Chamaeleon, and Tech Deciphered.
So two things, I think, on contacting me, maybe to start with the more practical things. LinkedIn is the easiest way. Do write in the note that, you saw me on the panel, etc. I normally link up with everyone. If I didn't, it was by accident. I don't really have a problem with that. Normally there's three types of people that reach out to me after these events. Some are service providers. With service providers, as you guys can imagine, I have a lot of, stuff in our stack, and we work with a different number of people, from law firms to investment banks and all of that. So if you can sort of send me some canned information, I'm happy to consume it and look at it, etc. Jumping on calls, spending a lot of cycles is a little bit more complicated, or getting that warm intro or referral of someone that you work with that I know really well might be a good way to then start that discussion. The second type of people are people that are in idea mode, which is great. People that are like, I'm going to start my next startup in a year's time or 2 years time or whatever. And they reach out for picking my brain. It's tough. I don't mean to be an a-hole, but it's, my time is limited. And so, as you can imagine, there's a lot of people who want to pick my brain, fortunately. But I have my portfolio companies, the firm, I have the podcast, there's a bunch of other stuff. So I normally, unless there's, again, a warm mentor or someone that wants me to talk to that person, I will likely say, let's talk in the future if you're doing the company and when you're there. The third type of people are people that are actually in the midst of doing a startup and have a pitch deck, etc. And there it's very simple. I'll connect. If you guys are interested, I'll give you my email address, and then we can process the deal properly, look at it, and come back to you. So that's normally how I process things. In terms of Chamaeleon and Tech Decipher. Tech Decipher is the podcast of decipheredshow.com, which you can see. We're now in our third season. We're sort of a top 3% podcast globally across not just tech, but across industries. We have sort of books almost that we talk about. It's like 2 episodes on Bubble, 3 episodes on Silicon Valley, 3 episodes, a trilogy on SaaS, software as a service. So that's more my multicasting thing. Obviously, if you have opinions or things that you would like us to discuss, we're happy to talk about it. And feedback is always welcome. As Chamaeleon goes, right now, we're still figuring out some of the aspects of what we're going to do in terms of thought leadership and how we're going to manifest that. We do organize events. Our events normally fall into 2 categories: invite-only stuff. We do 2 big events a year. Unrestricted, which is our AGM, where we invite a bunch of our portfolio companies like everyone does, but we also invite Hashtag in, and we invite friends of the firm, et cetera, et cetera. And that's our big one. And then we have, once in a while, we do some thematic events, like we co-organize stuff with Silicon Valley Bank, with corporations, with friendly people to us. So that's the invite side. Then there's the invite only side. Then there's the non-invite only side. We did an event for SF Tech Week last year, where we did publish it on SF Tech Week. We accepted all entrepreneurs who came on board. And normally these events always have content of, a short panel with some of our members of #KN, like incredible people that are part of our network. Margot Georgiadis used to be the CEO of Mattel and Ancestry President of Google Americas. Brett Bibby was the Chief Product Officer at Unity. We had Duta, who was the former Chief Customer Officer at Pinterest, now at Active Campaign. I mean, we have amazing people that join our events, and everyone's invited. You should just register and come along. The final thing I would say, proactiveness. If you have an event that you're doing or something that's interesting and exciting that you think would be a win-win, it's interesting to you guys, it's interesting to us, ping me. Worst case, I'll say, look, we don't have time, or it's not really around, whatever, but best case, maybe we do something together.
Well, fantastic. We're going to shift to the question and answer session in a second, but let me just share, if you'd like to connect with me, feel free to connect with me on LinkedIn. You can also reach out to jason.gordon@klgates.com. I do keep office hours. Please don't send any confidential information. We'd have to clear conflicts, yada, 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 but happy to have a general conversation about what's going on in the market or startups. The other thing, not to be sort of left out since everybody else has sort of these value add things, is that this year I put together a limited beta that I'm testing, which is an on-demand video resource for those entrepreneurs who are looking to understand the legal framework of getting from formation through seed financings using safes and convertible notes through their first preferred stock financing. Working title is Venture Capital Training Camp. It's on Teachable. I've sent a link to you in the chat if you want to check it out. Again, it's in beta. We're going to reshoot this year and looking for some feedback if you got it and you check it out. With that in mind, thank you so much, panel. Your work is not done. We're gonna transition over and take some of the questions. I'm gonna try and pick out questions that are questions of general applicability first. So, and if you've got a question, if you're in the audience, check out please use the Q&A function as opposed to the chat function. Let's see here. I think we answered that one. So,
yes.
This is maybe this one's a little directed towards Nuno and his quant fund, but can we talk a little bit about how the VC industry is sort of changing and shifting? And this is interesting, 2023 and beyond, in terms of how it's sourcing deals and running deals. And what kind of technology are you using, and what kind of processes have changed? Because we've also seen that in COVID too, right? There used to always be in-person meetings, now no longer.
I won't over-evangelize, right? But I would say, as I said earlier, really, there's two fundamental things we do as fund managers, right? We invest in companies, we liquidate our investments in those companies, right? We turn an equity back into cash capital, right? The industry has gone through a lot of epics, right? And I won't go back all the way back, right? So I won't go back to carried interest. Actually comes from ships. It doesn't come even from venture capital, right? That's why it's called carried interest. It was carried by a ship. And therefore I would keep part of that carried interest for myself, because I was taking the risk as the ship owner, right? In carrying those things, right? So I would go all the way back, but I think we've gone through different epics. I think the last 15 years have been interesting, with sort of a playbook that has gone more and more open, brand building, sort of the upfront ventures, Andreessen Horowitz model, the value to startups model, a lot by Andreessen Horowitz. Let's have a ton of people, NEA as well. Let's have a ton of people helping with sales and all that stuff, etc. What's the next big thing, right? I think the next big thing, and I can't tell you if it's this year or it's next year, or if it's in 10 years' time, I have no clue. We're doing that, is the belief that you have to augment yourselves and be more fact-based for the two critical things that you do, which is the picking and the exiting. And the picking comes from deal sourcing, from sourcing deals. The industry has long talked about proprietary networks. I guess in the good old days, it used to be the country club you used to go to. It might be, I'm ex-Stanford or Stanford alum, or I'm ex-McKinsey, or I'm ex-Facebook, and therefore I have access to those people leaving those firms or those companies. We believe the ultimate proprietary network is an unbiased proprietary network that gets built through data. And we can actually aggregate that data. It's a very complex problem to solve. The data is very noisy in early stage. But we can get that data, process it, and do stuff on that data that allows us to actually reach out to companies and be more outbound than inbound, as I said, which is, again, almost quasi-blasphemous in the industry today, right? Normally it's about inbound and it's about brand building. And then be fact-based during due diligence. Fact-based during due diligence, optimize, look at data, see what the benchmark looks like. For example, for us, it's like if it's a well-being and fitness company and consumer, we can see how they benchmark against other well-being and fitness consumer companies. We have data, not only secondary data that we buy or that we scrape, but we have primary data. We have data that was sent to us by other companies. We don't share that data with their competitors, but we use it for our own purposes. And so that's the due diligence element. And then getting into the deals, there's a little bit more art and science. Is how do you get into the deal? You show value add. People want to work with you. They want to work either with Nuno or Songi or Alex. So that's my partner's names. And they want to work with us. So that's the first part of the equation, right? Getting in the deal. Then the second part of the equation is when do you get out? As I was mentioning before, as an industry, we're poor. I mean, we have a team of quants actually on board, not just the technologists, but we also have quants. And one of them is ex-Goldman Sachs. And when he joined us, is like, look, you were very kind. You introduced me to a couple of other VC firms that you think are doing quantitative stuff. They were very kind. They gave me their time and I talked to them. I looked at papers, I looked at stuff in the industry, etc. Nobody, for example, can answer to me a very simple question, which is I have 5 companies in my portfolio currently. Question number 1, I'm going to do company number 6. How does it change the risk of my portfolio? Nobody can answer that question for me. 0, right? Nobody can answer those 5 companies. What risk profiles do they fit in, right? How did it link to public markets, for example, in the US? Nobody can answer stuff like that. I mean, in this guy coming from Goldman and being in their internal risk analysis team, he was like, there's something wrong with this asset class, right? He had never worked in venture capital. There's something wrong with this asset class, right? I mean, we can't calculate risks at all. So that's the other type of stuff that I think is going to be innovative. So just to answer the question in one word, I think there will be more and more technology used in the future to augment, it's not to replace, to augment the venture capital activity. I think as an asset class, growth already has quite a bit. Hedge funds have it. A lot of the private equity funds already use a lot of technology in-house. I think venture capital is about to have its Renaissance capital moment. Renaissance capital was one of the first big quant hedge funds that used a lot of technology and data to be more fact-based as a hedge fund. I think we're about to have sort of that Renaissance capital moment. I think we're one of the precursors of that. I know there will be many others. I know there's many others that already say they're doing it. Some are not. But I think that's the next big movement. Maybe there will be other movements, but that for me is one of the next big movements around venture capital.
Any further observations, Ekta or Bill, or there are certainly a host of other questions that we can try.
Yeah, let's. I mean, yeah, we can talk forever on the evolution of the venture capital industry. I'm not sure how. Let's get to the.
So one thing actually, I did want to circle back to this. I think we kind of hit this question maybe on the side, but sort of what verticals do we see, or what verticals are you seeing sort of strengthen? Which ones do you see soften? I know Ekta, I believe I think you mentioned telehealth maybe before, and some of that was a lot of that seemed to be COVID driven. But what do we sort of see, or what are you seeing in the market?
Yeah, like I said, telehealth is definitely on the decline. And then, all those companies who were relying solely on building this online presence without a deep underlying IP behind them are going to have a shakeup. They're not going to necessarily wipe out, but they need to show their differentiation beyond just being a platform to connect people online. So that the value proposition has to be much deeper than that. And actually, there was a question, and my mind kind of went towards it. I think it's a question raised by Lewis in the audience. I was attracted to that question because that's kind of closer to me on how how entrepreneurs should engage with CVCs. So
Please,
I've been part of and participated in various capacity in the innovation arms of several corporations, and being part of one in my prior life before Intel, actually, I know that corporations are increasingly opening up accelerators and innovation platforms to connect with them. Intel actually recently popularized, they started right before COVID, but popularized recently their Intel Ignite program, for example. That's another way for entrepreneurs to connect with what's happening in the ocean. And LG actually hosted an excellent conference, LG NOAA, which is an event I attended as well. And I think that's a good way, again, for entrepreneurs to connect with LG. NVIDIA has a similar program. I love Hyundai's Cradle. They call it Hyundai Cradle. These are not all CVCs. They are all in accelerators, innovation arms of corporations, and they are a good way to understand how well an entrepreneur will be able to strategically fit within the ocean. I think this is a good way to vet themselves and see whether they will be, their product will be of strategic interest, how closely they can bind themselves to the roadmap of that corporation. And once they are onboarded with regard to being an important part of the corporate's roadmap, then the CVCs will automatically get very excited because they have done the diligence on the strategic side of, or strategic relevance that is needed for the CVCs to make an investment. And they just need to obviously build upon their financial strength, and they have to look at the financial potential of the company to make an investment. But with that pre-work done by the entrepreneurs in engaging with these innovation arms, they have a better chance of success and better years from the CVC, I think.
And let me just, expand upon what Ekta is saying and emphasize something that the point she was making, which is, and it applies to contacting any investor generally, which is, please do your homework and personalize your outreach to any investor you reach out to. And so I do think, a lot of entrepreneurs think when they go to a CVC, they go to Toyota or whatever, and the attitude is, well, you're Toyota, you're a car company. I've got a technology that's relevant to a car company. Well, that's not going to grab their attention unless you show that you really understand what they've been investing in. You take the time to read their mission and their focus to understand what's really going on, and you tailor your communication to that specific investor. Just way too often, you just see entrepreneurs who insanely they use boilerplates to reach out to investors. They show, no indication that they've done any homework. If you do the homework and you see, oh my gosh, they've already invested in a company in my sector, you're going to have to differentiate your company from an investment they've already got to make sure they don't say, oh, we're already investors in whatever, right? So you've got to do the homework. You've got to be specific. Unfortunately, that's painful, and it's, you're still going to be rejected at least 9 out of 10 times. But unfortunately, that's just the reality of connecting up.
You'd be shocked. 90% of startups that we talk to still don't look at our website before jumping on a call with us. We have a TLDR there saying stage, size of check, where do partners focus, what's distinctive about us. And
Right.
Still at the end of the call, I always ask, I do this with startups, I always ask at the end, you have questions for me? And the questions are always the same. I mean, asking me what the process looks like, great. It's not on the website, I will explain to you. But asking where do we invest in, size of check, whatever, I'm like, mate, can't you just see it on the website? All due respect, right?
Yeah.
What do you focus on? It's like, it's on the website as well.
Yeah, right. So, that's just it seems obvious, but repeating it, right? So.
Right, and some other sources of information would include, PitchBook or Crunchbase. Obviously, lots of folks have an online presence. You can go on YouTube. You can check out, you can try and get inside their head a little bit. Not to steal, not to cut you off, Bill, but just to flesh out some other meaning.
Yeah, and then again, last fleshing is if there's a target, if it's a CVC or an investor that's an obviously really, really good target, not just because it's Andreessen Horowitz and they got a lot of money, but if there's a really good fit, use a multi-pronged approach to try to get in. Don't just try to knock on the front door and hope they'll answer. Find other portfolio companies, other founders. Talk to their lawyers, talk to their bankers, talk to their other, find other channels in. It's sales 101. It's really, you got to figure out how do you get to your buyer, and that's you got to take multiple pathways maybe to get there. So consider, don't just assume that there's this one person and that's it. Figure out another way to get there. Okay.
I would just say one thing. I mean, there's a lot of this debate that I hear sometimes from, I need to talk to a bunch of VCs and whatever. I don't have time, right? This is not about time. This is about the best people prepare. The people that are not very good don't prepare. I remember I had the first call. It was almost a cold call with Margot before she joined Ashtek. As I said, Margot used to be the CEO of Mattel and the CEO of Ancestry.com. Right? She's board member at McDonald's, right? She has better things to do in her life to talk to some guy that reached out to her almost cold, right? Mm-hmm. When she jumped with me on the call, she was like, I listened to an episode of your podcast. I really liked it. This was the episode. I disagree with you on those two things. Mm-hmm. That's what prepared people do. It's not that she has plenty of time in her hands. It's that she prepared, right? So that's it.
So there's a question about whether or not now is a good time. This is addressed in sort of with respect to a prop tech cloud SaaS company, but I want to kind of zoom it out a little bit and just ask, the question is now a good time to raise between $500 and $1 million, or maybe even more broadly, is now a good time to be an entrepreneur? If let's say, for example, you have been kicking around an idea for quite some time and you were in a large tech company and you're no longer in a large tech company, should you be considering entrepreneurship, or is this the end of venture as we know it?
The sky is not falling, right? Yeah. I mean, this is, as Ekta said, the sky is not falling. There's a ton of money out there. There's a ton of opportunity for innovation. We have never, ever been in an era in the history of venture capital and entrepreneurship. We've never, ever been in an era where so many elements of our world, of our lives, of our business, of our entertainment, of our, corporations are open to entrepreneurial innovation. And so in terms of, what's the next big thing? I mean, the next big thing is something we haven't put a label on yet, or is at least not generally touted. Your job as an entrepreneur, as an innovator out there, is to figure out where's a white space where you can penetrate with some compelling value proposition to create a beachhead for a new business that has the opportunity to grow to be a successful company. You don't have to be a unicorn. I mean, but there's a ton of money out there, and every dimension of the innovation ecosystem is broader and deeper than it ever has been. The deal terms have shifted a little bit. The considerations are different. The language you use, the vision you paint, the projections you send, you've got to, adjust to the current, environment. But boy, I mean, there's plenty of opportunity out there.
It is definitely better, I think I want to add here, to start a company now than before. Or maybe in the last 2 years, or maybe at a time when there was this delusional, valuation, and the justification of valuation was delusional. It is because if you're starting low, there's many more opportunities to go higher up in the chain. And if you're starting high, it's difficult to take a setback and come to reality or come to terms with reality. So I would say this is the best time to start a company. This is a good time to fundraise, because you will do the diligence, you will see the real market opportunities out there, and you'll command a valuation that is more realistic than the previous times that we have all seen. And having said that, I think COVID has really made enterprises embrace technology like never before. Sectors who were not even closer to tech are now embracing technology. So COVID has already laid the ground for acceptance of tech. You need to find your swim lane into that ground, I think.
I would add venture capital as an asset class. It's very funny that people now are saying it's dying. I'm like, no, it's actually just, it's finally becoming like, it was cool and whatever. It's now even more significant and more lasting. And all these things have different roles, right? I remember when, I was starting this, angels are going to kill VCs. Then it was crowdfunding was going to kill VCs. Then in the past, I'm sure there was grants and money from governments was going to kill VCs and all that. And nothing ever did, right? And they all have a role. Grants have a role, right? Angel investors have a role. Crowdfunding has a role. All of that has a role. And venture capital's role is just upstacking. It's more and more. It's not just more capital. It's more importance in the sliver that it lies in, which is early to mid stage. That's what venture capital is. It's early to mid stage, right? Then there's private equity. We're a subset of private equity. Let's not get into nomenclature, but there's classic private equity, and within that you have buyouts and you have all that stuff. And then there's, there's hedge funds, and it's horses for courses. I think as an asset class, we are an asset class that's growing, that's becoming hopefully more disciplined and better over time. There's always noise. There will always be noise in all asset classes. That will not change. There will always be tourists in all asset classes. That will also not change. We're here to stay. I'm very bullish about the industry. I think the industry is going through its renaissance in some ways, right? And it's been around for a while, but it's going through its renaissance. So very, very bullish on it.
So let me ask a question that just came in, and I think it's very important. It's asking for perspective on diversity, equity, and inclusion in tech entrepreneurship and venture capital. I ask sort of in 2023 and beyond. I will, I don't have access to all the data, but what I could pull quickly, at least with respect to companies that either have a female founder, one female founder, or the founding team is all female, it does look like this set a record year. I think last year was 2021 for the number of deals, which hit those criteria. This year was not far off, but it's a sort of second. And of course, there have been fewer deals. I think this year there's been a bit of a pullback in venture capital in general. So that might be part of the data, but I'd be interested to hear the panel's take and sort of what you're seeing.
I'll do something really quick. I always felt very guilty, and this is my mea culpa, that until very recently, a couple of years ago, I'd never invested in female-led startups. I made many efforts throughout it. I did positive discrimination. I did all sorts of things, and somehow it never worked. We launched a year and a half, Chamaeleon. 40% of our companies are the founder CEOs are women. 40%. 50% of our companies would be de facto ESG companies, done, right? There's no argument whether they're ESG or not, right? My co-managing partner is a woman. So it's two of us managing partners. I'm a man, she's a woman, great. And it's very interesting because something shifted, and I'm not sure what shifted. Because if you ask me, oh, did you guys go to the market? Not at all, right? We're trying to be as unbiased as possible. And we're looking for great deals, and we're looking for great founders, and we're looking for great partners for our partnership, and we're looking for an amazing way to scale. It's just starting to happen. And I have to say, it's almost magical. It feels sometimes a little bit too magical, but it's almost magical. It's like, I think we're at the right point. We're at the right point. If there's anything that I would complain about is in venture capital, getting, for example, female talent is extremely difficult. Getting Latino talent in venture capital, extremely difficult. We've also tried to do a little bit of positive discrimination in processes and channels that we use for hiring. It's extremely difficult. And I don't know why the reason is. I don't have any major mega theories or macro theories. but it's the positive thing I have to leave with you guys today, and it's none of our brilliance. It wasn't strategy. We're not amazing. We're crap at this, honestly. Is it's changed. The momentum has changed, and I think that's a wonderful thing that's happening right now in the market.
You know, I guess I'll be. I won't disagree. I can't disagree with Nuno, obviously, because his data is his data. I think maybe what he's seeing that we're also seeing is, you know, traditionally venture capital was investing in technologies that you know, that were disproportionately sort of male engineer kind of sectors, and I think that, you know, perpetuated some of the imbalances. And what we've seen happen is, as we are moving into sort of broader and broader and broader sectors that, you know, in our society, across gaming, across entertainment, across media, you know, across even space tech, you know, one of our space tech investments is co-founded by a woman. You know, we're just seeing more and more representation by broader groups as the sectors that venture capital is investing in are expanding. Interesting question in traditional sectors. I think we're getting a little bit better in that, in terms of the traditional, you know, hardware sector, hardware, software, communications, manufacturing stuff, enterprise stuff. But I think we're seeing some movement, but you know, God bless you guys at Chamaeleon. You know, the numbers are still not at all acceptable or impressive in terms of the broad brush that we're seeing out there. But we do, you know, it's a very conscious criterion for us as well. We have 40% of our professional staff at Pegasus is female. You know, actually, how to say this? I don't know if I'm allowed to, but, you know, more than half is non-white. Is that right? Okay. But in any case, you know, in terms of what we see out there, it's still very, you know, it's still very disproportionate. But we do have it as a criterion for, you know, and we believe deeply that, you know, that diversity of perspective is a critical component in having a full team. If all you have are a bunch of frat bros who, you know, all see the world the same way, you're going to have very narrow perspectives in terms of the company. And so, you know, we've seen that problem. Thank you, Sam Bankman, for you.
And I do want to make sure that Ekta has, she gets the sort of last word on this.
Sorry, yes, Ekta, of course.
Yeah.
Well, I'm representing the female population, I guess, in my firm. But in terms of, you know, what we are looking for, and this is an interesting exercise that I happen to do, not intended to do. There's a corporation, there are two different corporations who came to us and asked for the best companies, one in explainable AI, I can tell you, and the other in a niche sector in logistics. And after doing my due diligence, and this is not, I was looking for not looking at the founders totally, just from the perspective of technology, I happened to find that the best of the two companies, in one in explainable AI and the other in logistics, is run by a female founder. And when it comes to sort of corporations and their interest in investing in companies, they really care about the strength of the technology and the potential to go to market. They may look at who helps the company in terms of the advisors. So I can tell you the logistics company, for example, had a very senior ex-Walmart exec on their advisory board. And it's a smart thing to do because it, you know, it empowers their vision to go to market. And so my word out to the female entrepreneurs would be, do your best, get a good understanding of what will empower your vision to go to market, and there will be resonance on the investment side eventually. Are we there yet now? I don't think so. Not when it comes to institutional investors, but when it comes to corporate investors, I think there is less of a bias towards investing in companies led by female founders.
Well, thank you. Thank you very much, Ekta. Thank you so much, Nuno, Bill. I want to thank each of the audience members for attending live or on recording, as well as Idea.IPO for organizing and my firm for supporting this event. This has been What to Expect in 2023. Hope you all are excited for this year. I am, and I'll let all the audience members get back to building their great company. Take care. Bye-bye.
Thank you.
Perfect. Thank you. Bye.
Thank you, everybody. Thanks, Jason. Thanks, Nuno.
Good to see you all.
Ekta.
Thank you, everyone. Bye-bye.
Thank you, everyone.